In this video, we'll show you 3 dirt cheap stocks smart money is accumulating right now. You are going to see how a dominant digital platform, a category-defining online retailer, and a global leisure operator are being priced by the market as if their best days are behind them, even though the fundamentals tell a very different story. These are businesses with real scale, real cash generation, and long-run relevance. They are not speculative plays, and they are not built on hype. They operate at the center of how people communicate, how they care for their pets, and how they spend their leisure time. Each one has durable advantages that allow them to compound value over many years, even through economic cycles. By the end of this video, you will understand why the market is discounting them, what it is missing, and how they can fit into a long-term portfolio built for growth and resilience. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Let's start with the first stock on the list. Meta Platforms, ticker symbol META. Before talking about numbers, it is important to understand why this business matters. Meta sits at the core of how billions of people connect, communicate, and share information every single day. Its platforms are woven into daily routines across the globe. This is not a trend-driven business that people casually move in and out of. It is a habit-forming ecosystem that benefits from massive network effects. The more people who use these platforms, the more valuable they become to users and advertisers alike. What gives Meta its moat is scale and data. Operating platforms used by billions of people creates an enormous advantage that is extremely difficult to replicate. This scale allows Meta to continually refine its products, improve targeting for advertisers, and introduce new features that keep users engaged. Advertisers follow attention, and Meta controls a significant share of global digital attention. That creates a powerful and durable revenue engine over the long run. The market has spent a lot of time focusing on concerns around advertising cycles, heavy investment spending, and longer-term bets that take time to pay off. Those concerns have created volatility in the stock price and pushed valuation metrics lower than where they traded in more optimistic periods. But volatility is not the same thing as permanent impairment. Meta has already shown it can adapt its cost structure, prioritize efficiency, and refocus on profitability when needed. One of the most important growth drivers for Meta is its ability to monetize engagement across its family of apps more effectively over time. Even small improvements in ad performance can translate into meaningful revenue growth when applied across such a large user base. At the same time, Meta continues to invest in new formats, new tools for businesses, and new ways for creators and brands to reach audiences. These investments strengthen the ecosystem and reinforce long-term relevance. Another key factor often overlooked is Meta's financial strength. The business generates significant cash from operations, giving it flexibility to invest, buy back shares, and weather downturns. This cash generation acts as a buffer during slower periods and allows management to play the long game rather than chase short-term results. That discipline is critical for compounding value over time. From a valuation perspective, Meta has traded at levels that imply skepticism about its ability to grow or maintain margins. Yet the core business continues to demonstrate resilience. User engagement remains high, advertising demand recovers over time, and operational discipline has improved. For patient investors, this gap between perception and underlying business strength can create an attractive entry point. Meta is not a get-rich-quick stock. It is a large, mature platform with multiple levers for growth and a proven ability to adapt. When you buy it at a discounted valuation, you are buying a business that can continue to generate cash and reinvest for many years. That combination of scale, durability, and long-term optionality is exactly what you want when allocating a modest amount of capital like $1,000. With a massive market cap of $1.81 trillion, Meta continues to be a dominant force in the digital space. Looking at the fundamentals, we're seeing a PE ratio of 30.49 and an EPS of 23.50. Their 2024 performance was nothing short of powerhouse status, pulling in $164.5 billion in revenue and walking away with a net income of $62.36 billion. Before we move to the next stock, let me quickly share today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second stock, Chewy, ticker symbol CHWY. Chewy matters because it operates in a category that is both emotionally driven and structurally resilient. People care deeply about their pets, and spending on pet food, supplies, and healthcare tends to hold up even when consumers cut back elsewhere. Chewy has positioned itself as a trusted destination for pet owners by focusing on convenience, reliability, and customer experience. The company's moat comes from customer loyalty and recurring revenue. Chewy's auto-ship program encourages repeat purchases and builds predictable demand. Once a customer sets up regular deliveries for essentials, switching becomes less likely. This creates a sticky relationship that supports long-term revenue visibility and reduces customer acquisition costs over time. Chewy has also invested heavily in building its brand as a pet-focused company rather than a generic retailer. That focus shows up in customer service, curated product offerings, and an understanding of pet owner needs. This brand trust is not easy to replicate and acts as a barrier to entry for competitors trying to win over the same customers. From a growth perspective, Chewy continues to benefit from the ongoing humanization of pets. Pet owners are spending more per animal on food quality, wellness, and convenience. Chewy is well positioned to capture this spending through its online platform, logistics network, and data-driven personalization. As order frequency and basket size increase, the economics of the business improve. The market has been cautious on Chewy due to concerns around margins, competition, and near-term profitability. Those concerns have weighed on the stock and kept valuations compressed. However, focusing only on short-term margin pressure misses the bigger picture. Chewy has been working to improve operational efficiency, optimize fulfillment, and drive higher margin categories. These efforts take time, but they can materially improve profitability as the business scales. Chewy's financial profile reflects a company transitioning from pure growth mode to a more balanced approach that emphasizes sustainable economics. Revenue growth remains meaningful, while cost controls and efficiency initiatives support improving cash flow. This transition is often uncomfortable for the market, but it can create opportunity for long-term investors who understand the underlying business trajectory. Another important element is Chewy's balance between growth and discipline. The company has demonstrated a willingness to adjust strategy when conditions change, focusing on areas that drive the most value. This adaptability reduces risk and supports long-term compounding. Chewy, with a market cap of $12 billion, carries a much higher PE ratio of 61.94, signaling that investors are still pricing in significant future growth. On the earnings side, Chewy posted an EPS of 0.47 on a total revenue of $11.14 billion for 2024. While the top-line revenue is strong, their net income came in leaner at $39.58 million, showing just how competitive the pet retail margins can be. At current levels, Chewy is priced as if its growth is permanently impaired or its business model is flawed, yet customer loyalty remains strong, recurring revenue continues to grow, and the pet category itself remains resilient. For investors willing to be patient, this disconnect between narrative and fundamentals can be attractive. Chewy may not deliver explosive returns overnight, but it offers exposure to a durable category, a loyal customer base, and improving economics. When you buy a business like this at a discounted valuation, you give yourself room for both multiple expansion and earnings growth over time. That is a powerful combination when investing with a limited amount of capital. Now let's turn to the third and final stock, Carnival, ticker symbol CCL. Carnival matters because it operates at the intersection of global travel, leisure, and experiences. Cruises are not just transportation, they are immersive vacations that bundle lodging, dining, entertainment, and destinations into a single offering. This value proposition appeals to a broad range of consumers and creates demand that extends across economic cycles. The company's moat comes from scale and asset intensity. Operating a global cruise fleet requires enormous capital, operational expertise, and regulatory know-how. These barriers make it difficult for new entrants to compete at scale. Carnival's size allows it to spread costs, optimize itineraries, and invest in fleet improvements that enhance customer experience and efficiency. The cruise industry has faced significant challenges in recent years, and those challenges have left a lasting mark on investor sentiment. Carnival's stock price reflects skepticism about debt levels, profitability, and long-term demand. However, demand trends show that consumers continue to prioritize experiences and travel. Bookings and onboard spending provide evidence that interest in cruising remains strong. Carnival's growth drivers include pricing power, improved onboard revenue, and operational efficiency. As demand normalizes, the company has opportunities to optimize pricing and enhance margins. Onboard spending, which includes dining, entertainment, and excursions, adds a high-margin revenue stream that scales with passenger volume. Financially, Carnival has been focused on strengthening its balance sheet and improving cash flow. While leverage remains a key consideration, the company's ability to generate cash as operations normalize is central to the long-term thesis. Each incremental improvement in occupancy and pricing has an outsized impact on profitability due to the fixed cost nature of the business. The market often looks backward when valuing companies like Carnival, focusing on past disruptions rather than future earnings power. That backward-looking approach can lead to undervaluation when conditions improve. For investors with a multi-year horizon, buying during periods of skepticism can offer attractive risk-reward. After a few volatile years, Carnival is sitting at a market cap of $41–49 billion with a relatively attractive P/E ratio of 1539. Their earnings per share stand at $1.95, supported by a robust recovery in travel demand. For the 2024 fiscal year, the cruise giant generated $25 billion in revenue, resulting in a solid net income of $191 billion, signaling that the industry's wind is back in its sails. Carnival is not without risk. Economic slowdowns, fuel costs, and regulatory changes can all affect results. However, the company's scale, brand portfolio, and operational experience provide tools to navigate these challenges. Over time, a normalized operating environment can support meaningful earnings recovery. At current valuations, Carnival is priced as if growth will remain constrained and margins will never fully recover. That assumption may prove overly pessimistic if travel demand remains resilient and management continues to execute. For investors allocating a small amount of capital, this asymmetry can be compelling. Carnival offers exposure to a recovery-driven story with tangible assets and real demand. It is not a speculative concept. It is a global operator working through a difficult period with a path toward normalization. When purchased at a discount, that path can translate into significant upside over the long run. Now that we have covered all three stocks, let me share a quick message for those of you who want to go deeper. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we wrap up, I want to hear from you. Which of these three businesses do you believe has the strongest long-term advantage, and why do you think the market is mispricing it today? Share your thoughts in the comments. To bring everything together, these three stocks represent different paths to long-term compounding. Meta Platforms offers scale, cash generation, and platform durability in digital communication and advertising. Chewy provides exposure to a resilient category with loyal customers and improving economics. Carnival offers a recovery-driven opportunity tied to global travel and experiences. Each of these businesses is being valued by the market with a degree of skepticism that may not fully reflect their long-term potential. That skepticism creates opportunity for patient investors willing to look beyond short-term noise. Investing $1,000 across companies like these is about positioning yourself for compounding over time, not chasing the next headline. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.